Okay. So in this question, which is illustration number 5 in your Kaplan book, you see the draft statements of financial position for plant and shrub company on 31st of March 2007 have been provided. Okay. And then they have given you some additional notes over here, which are just four of them. So you see no impairment of goodwill has occurred today. So that's actually a very good thing. But here, what's new in this question is that so far we were calculating the goodwill based on full value method, but in this question, what you have it is on the proportionate method. Okay. And yes, and we do have a cash in transit difference over here. It's like a receivable payable between the parent and the subsidiary, but the balances are not tallied, and that's because of a cash in transit. So it's pretty much a very simple and straightforward question. Okay. So before we start the question, as you all know, that what we have to do is we have to prepare the group structure, and in that the parent company is basically the plant, okay, and the subsidiary company is your shrub, okay. Right now we need to find out the date of acquisition first, right? It says plant acquired 80,000 shares in shrub in 2001, right? Right now we are in 2007, so it's basically like 7 years before. So 6 years before actually. So let's suppose it's by March, right? Here the difference is too much, so we it's perfectly fine. I mean, don't have to be very exact because there are no such big adjustments over here too. Wait. So date of acquisition, which is 2001. Yeah. What you have to do is you have to find out the percentage of ownership over here. Okay. They don't tell you in terms of percentage over here, but they just told you number of shares that you have acquired 80,000 shares in. The plant has acquired 80,000 shares in shrub. So the total share capital of the company of the subsidiary is 100,000. So from that, you acquired 80,000 shares. You can see the nominal value is 1, so that means that the total number of share is also 100,000. So 80,000 divided by 100,000, that well gives me to 80 percentage. Okay. So we can just multiply, we can convert it into percentage. So this will give me 80. Yeah. And the NCI, you can figure it out that it's going to be 20 percentage then. Okay. So once you have done the group structure working, now you have to move on the next working, which is to find out the net assets of shrub company. Uh, when we acquired it, that's in 2001. And when we are reporting onto it, that's like when you're making the consolidated balance sheet. So that's 2007, I believe. Yes, correct. So now what do we have in their net asset is their share capital, share premium, and retained earning. So far we were getting share capital and retained earnings normally, but we might get other reserves, other components of equity, including share premium or revaluation reserve in the case of subsidiary 2, right? So for the reporting date, I just have to simply copy paste these figures, which is at 100, 30, and 20. Okay. So here we have your share capital. Then we have your share premium, and then we have your retained earnings. I'll just copy it down. It's 100, 30, and 20. 100, 30, and 20. Okay. And we can just add up one more row over here so that we can put our thousands, right? So this gives me 150 total, which is 100 plus 30 plus 20. So that's 150. Okay. Now share capital will remain same, which is going to be at 100. But here they have given you that the shrub reserves included a share premium of 30 and retain earnings of 5,000. Okay, so that's 100 over here. This is not changing, it's 30, and this is uh how much was it? 5. Yeah. So this gives me a total of 100 plus 30 plus 5. So that turns it out to 135. Now, we don't have any fair value adjustments over here, right? But that's one extra thing which I want you to understand, that the difference, you know that this 135 will be a part of the goodwill calculation, and this 150 will be a part of your NCI calculation, and the difference will be for the retained earnings. Okay, so that's 150 minus 135, right? So that's 15, and that's going to be a part of your group retained earnings. However, what I need to make you understand is that it's not, it's if, let's suppose, you would have a revaluation balance over here. Okay. So I'm just going to slightly change this question over here, right? So here, if you can see, like, let's say that this is revaluation surplus. Okay. And here, it's not 30, it's actually 20. Okay. So now I do understand that this 135 will be used for the goodwill calculation, okay? And this would be used for your NCI. But in this case, now you need to be very careful that it's not the 15 which you will be using for the group retained earnings, because so far, whatever questions we have done in the previous videos, uh, the balance change was only in the retained earnings. So that's why we were calling it the increase will be a part of the group retained earnings actually. Okay. But in this case, for the retained earnings, it's going to be 150 minus 135. So the difference is actually 15. But you do understand that from that 15, 10 is actually an increase because of the revaluation surplus. Okay. So that 10 will be subtracted. So what will be used for the group retained working will be only 5. Okay. Uh, I'll write down a note over here for you. After adjusting the increase in revaluation surplus. Okay. So while you're doing the group retained earnings, you will just take the share from 5, like 80% share from 5, basically. And the rest difference, which is of revaluation surplus, that's a 10 difference, that you have to make a separate working for the revaluation surplus. Okay. Like, let's say here, you have to make a separate working for the revaluation surplus, and you can mention it as working number 6. That's the case if the I mean, there is a difference between the what is the revaluation surplus at the acquisition date and at the reporting date. If there's no difference, then you can do it the same way as we have been doing it so far. But however, if the question says that the revaluation surplus at the acquisition date was 20, and at the reporting date it's not 20, but in fact it's 30 basically. So in that case, what you have to do is that, like how you were doing for the group retained earnings working, you have to do the same working for the revaluation surplus. You were also taking parent 100% retained earning. Here also you will take parent 100% balance on the revaluation surplus, and then from the subsidiary you just have to take your post acquisition share. Okay. So post acquisition share, so that's basically going to be, let's say, like with the same example, it's 80 percentage of the difference. So the difference is basically 10. So 30 minus 20, you will get a difference of 10. If I just put it up into the formula, it will be giving you 8 basically. So that 8 is, yeah, that 8 is actually your share in the post acquisition revaluation surplus. technically you're exactly doing the same thing. Like here for the retained earnings, you took a balance of 15. Okay. Sorry. Yeah. 15. For the retained earnings, you took a balance of 15 basically. The difference in the revaluation surplus is 10. Yes. Okay. So here, I guess it's a calculation part. Yeah, got it. Okay. Yeah, see, the total is not 135. The total over here is 125. Okay, yeah, that's the mistake over here, I believe. Yes, so from 125, it went to 150. So basically, the total increase in the net asset was by 25. But from that 25, 15 is something which you're putting up for the group retained earnings. Okay, and the rest 10 is going to be a part of revaluation surplus. So from that 10, that 80 percentage, you're putting it in the revaluation surplus, and likewise, when you were doing working number five, uh, for the group retained earnings, which I will be showing it to you again also, we have to take the parent 100 percentage group retained earnings, and you also have to add up the subsidiary post acquisition share. So in that case, it's going to be 80 percentage of this one, 15. Okay, so you can see over here that the difference between the net asset at the acquisition date and the net asset at the reporting date was 150, right? So there's a total difference of 25. Normally, we were taking 25 and we were, putting it into the group retained earnings. But in this specific scenario, you can see the revaluation surplus has also increased from 20 to 30. So I cannot say that the total entire difference of 25 is all because of the retained earning. From that 25, 15 belongs to the group retained earning, and the rest, 10 belongs to the revaluation surplus. So you take 25 into 80 percentage, you will get 20, but you have to break it up between the group retained earnings part and between the revaluation surplus part. So from that 25, 15 will be a part of the group retained earning. So you have to take 80 percentage over there, which will make it to 12. And the rest 10 is because of the revaluation. So you have to do an other working for it. And that's where you will take 80 percentage your share. So that will be 8. So 12 and 8 is again back 20. But the point is that we are breaking it up into the different workings, one for the group retained earnings and the other one for the revaluation surplus. Okay. So once, well, now coming back again to this question, that the net asset at the acquisition date was 135 and the net asset at the reporting date was 150. So the total increase in the net asset have been 15. And in this case, because the share premium or the revaluation surplus, whatever, it's exactly the same. So the entire 15 would be a part of the group retained earnings. So this 135 goes for the goodwill, this 150 goes for the NCI, and then this group 15 goes for the group retained earnings. Okay. So now we can move towards a working number 3 where you have to find the goodwill. But in this case, the goodwill is only based on a proportionate method. So what I'm going to simply do is I'm going to write down, I just have to find out the goodwill for 80 percentage only because it's proportionate method. So we'll take your cost of investment, which is basically here, investment in subsidiary at cost of 180,000, and what we have acquired is less share in net assets. So we have acquired 135. uh, from that 135 we have acquired only 80 percentage of the net assets, so that's 108. So the extra what we have paid is 72, and that will consider to be as our goodwill. Okay, so we don't have impairments, we don't have full value method of goodwill, so that's all what we have to do, right? Okay, so now once we have done the working number three, we just have to move towards the next working, which is to calculate the NCI. And for that, we will only take the net assets actually. So net assets, it's 150 into 20 percentage. So you basically get 30. That's it. Goodwill, we will not be taking because the policy of the company is to not to record the goodwill of NCI. So that will be zero, and the total value of the NCI will only be 30. Then, okay, let's fill up with this group retained earnings working over here. Or, okay, we'll do another working, no problem. So here we'll go for working number five, which is group retained earnings. So, which is parent 100 percentage, okay, and parent retained earnings are 40,000. And put the three zeros. Yeah. And for the subsidiary, we have to take the post acquisition share in post acquisition. So that was a total of 15, and from there our share is only 80 percentage, so that's 12. So the total group retained earnings will be 40 plus 12. That will give me a 52. Right. So now once we have completed our five workings, we have to move towards preparing the consolidated balance sheet. Okay, for the plant group. All right. So now, like only this point is remaining, which is plant records showing 8,000 owing to shrub, but the shrub records show 8,000 owed by plant. The difference is explained due to cash in transit. Okay. So this is something which is left out. The rest of the workings we have already, the rest of the information we have already catered. So property, plant and equipment, you can just simply total them up to 100 plus 140. The investment which you have done in subsidiary will be replaced by the goodwill, and the goodwill what we calculated as per the proportionate method was 72. Okay, so uh, now you can see that there's no problem with the inventory because the difference is in the receivable and payable is because of the cash, right? So for as far as the inventory is concerned, I don't have any problem. I can just simply add them, and I'm going to get 30 plus 35, so we'll get 65. Okay. Now, but for this point, plants record showing 6,000 owing to shrub. So plant, the parent is saying that I owe 6,000 to subsidiary. Okay. But let's say what does the subsidiary have to say? But shrub records show 8,000 owed by plant. Subsidiary is saying that no, you owe us 8,000. Okay. So you can understand that parent is saying that we have to pay 6,000, but the subsidiary is saying no, you have to pay us 8,000. That difference is because of the cash in transit, because the parent has paid it, that's why they have reduced their liability, but the subsidiary has not received it, that's why their receivable is overstated in that case, right? So what we have to do is try to understand that we have to remove the liability, which is 6, payables debit by 6,000, and then uh, credit will be receivables by 8,000. Okay, and the difference is basically 2,000. So that's because of the cash, and the cash has not left the group. So we just need to add it back again. So that's 2,000 cash. So now when you are consolidating your receivables, you just have to add 20 plus 10 and you have to minus 8. That 8 is actually what the subsidiary is saying that I have to receive it from the parent. So you cannot show any receivable or payable within the group. So your net receivables turns out to be 22 cash, 10 and 5, but that 2000, that difference is like the parent has credit from its books, but the parent has not received it. It's actually not going outside the group, so we basically have to add back that 2. So that gives us 17 over there, a total cash balance. And likewise, the total of the assets would be 240 plus 72 plus 65 plus 22 and then lastly plus 17. So this gives me a total of plus 17. So this gives me a total of 416. As far as the equity is concerned, you will only write down the share capital of the parent. Okay. Premium only for the parent again. Retained earnings, we just calculated in our working number 4, sorry, working number 5, which is 52. So that's going to be here. And then we just have to add up one row for our NCI. So our NCI, we just calculated the value of NCI from working number 4, and that's going to be 30. So that turns out to be over here, and this will give me a total of my equity part, which is 210 plus 52, so that makes 262 plus 30, so that makes it 292. As far as the non-current liabilities are concerned, I just simply have to add up only parent because subsidiary doesn't have any of them. Current liabilities, I have to add both of them, 25 and then 40. But likewise, the parent was saying that we owe 6,000 to the subsidiary. So we just have to remove that 6,000 because again, it's within the group. So you cannot show any liability or receivable within the group. So after the deduction of that 6, the total current liability stands at 59. And if I add up my total equity of 292 plus my total liabilities, which include 65 of the parent loan notes and 59 for the current liabilities of both parent and subsidiary, it turns out to be 416, which is exactly my total of total assets, and hence the balance sheet is balanced. Thank you very much.